When we hear the words climate change, our minds usually jump to images of melting glaciers or polar bears, right? But today, we're looking at a different kind of ice, the kind that can freeze up the global economy. This isn't just an environmental story. This is about why climate change has become the single biggest financial challenge of our time.
So check out this image from the IMF. They call it the climate crocodile. And honestly, it's the perfect metaphor. The top jaw, that's the graph of rising global temperatures. The bottom jaw represents our economy. And see those little figures? That's us, trying to hold the jaws apart. But as you can see, those jaws are closing, slowly but surely. It really captures this idea of a massive, slow-moving threat that could eventually crush our markets.
This old line, it used to be funny, right? Because what could anyone really do about the weather? But here's the thing, that's not true anymore. We now understand that our actions are changing the climate. And that means we absolutely must do something about the enormous economic fallout. All right, let's dive into our first section, the climate crocodile. We're going to break down why this isn't just about the planet, but about our money, our investments, and really the stability of the whole global financial system. The physical impacts are becoming pretty obvious, but let's look at them through a purely economic lens. Rising sea levels don't just mean losing beaches. We're talking about threatening an estimated 15 times trillion dollars in coastal real estate. Harsher storms don't just ruin a weekend. They obliterate infrastructure, snap supply chains, and leave behind bills for rebuilding that are just staggering. So that brings us to Section 2, and a really big question. If the risks are so clear, why is it so hard to get things done? Well, the answer lies in this powerful idea called the tragedy of the horizon. Here it is, the central paradox in a nutshell. The generation that holds the power to really fix things, that's us, by the way, we're not going to feel the absolute worst effects. But the costs of preventing that future catastrophe, building new infrastructure, investing in green tech, well, that bill is due right now. It's this fundamental mismatch between who pays the price and who gets the benefits. And this slide, this is what that tragedy looks like in real time. Because of all the delays, the clock is just ticking incredibly fast. To hit the climate target scientists have set, we need a massive 45% cut in emissions by 2030. But look at where we are today. Global emissions are still going up. That horizon is rushing toward us a lot faster than we think. So how do you solve a problem like the tragedy of the horizon? Well, economists have a pretty powerful idea. You have to make those future costs feel real today. And the best way to do that is to put a price on the pollution itself. The key concept here is something called the social cost of carbon. It sounds a little academic, but the idea is simple. Economists try to calculate a single number, a dollar amount, that represents all the future damage that will be caused by releasing just one more ton of CO2. We're talking everything from crop failures to flood damage. $50. That was the central estimate from the Obama administration back in 2019. Think about it like this. Every ton of carbon we emit is like sending an invoice to the future for $50 worth of damage. Suddenly, a distant problem has a very immediate price tag. This slide just lays out the choice so clearly. We can pay now a predictable price through things like carbon taxes and get a managed, orderly transition. Or we can choose to pay later, and that bill will come in the form of disaster recovery, economic chaos, and just wildly unpredictable costs. Okay, moving on to Section 4. This is bigger than just one policy. Climate change is forcing a total rethink of the entire financial system. Central banks, huge investment firms, insurance companies, they're all scrambling to, basically, climate-proof our money. The first risk they're worried about is the obvious one: physical risk. This is the stuff that's easy to picture. A hurricane fueled by warmer oceans wipes out a factory. A wildfire tears through a community. A flood makes a whole portfolio of mortgages basically worthless. It's the direct, tangible hit to the balance sheet. But the second risk is just as big and maybe even more complicated. It's called transition risk. This is the financial risk that comes from actually solving the climate problem. I mean, think about it. If the world gets serious and puts new policies in place, the value of a coal mine could just plummet overnight. An oil company could be left with billions in stranded assets that can't sell. The transition itself creates huge financial winners and losers. Let's just walk through this chart because it's so important. At the top, you see those two risks we just talked about, physical and transition. But look, they don't just stay in their own lane. They cascade down, creating credit losses for banks, market losses for investors, and underwriting losses for insurers. These risks can infect the entire system and lead to slower growth for everybody. And if you think this is all just theoretical, it's not. It has already happened. The bankruptcy of PG&E, the huge California utility, was a perfect storm. You had the physical risk from droughts making wildfires worse, and the transition risk from the massive legal liabilities that came after. The Wall Street Journal called it the first climate change bankruptcy. It was a huge wake-up call, and it definitely won't be the last.
So, for our last section, we need to shift gears a bit. We've been talking about how to prevent future damage, but what about the climate change that's already baked into the system? This brings us to the age of adaptation, an inescapable economic reality.
And it is so crucial we frame this the right way. Adaptation is not giving up. It's not waving the white flag. It's a pragmatic, necessary defense against the impacts we can no longer avoid. It's about building resilience for the world we have now and the one that's coming. 260%. Just let that number hang there for a second. What on earth could that possibly be?
That was the economic cost of a single storm, Hurricane Maria to the island nation of Dominica, a financial blow that vaporized 260% of their GDP. It wiped out more than 2 years of the country's entire economic output. For the world's most vulnerable nations, this is the sheer scale of the challenge.
And this chart just lays the problem bare. It shows the adaptation funding gap. That tall bar is what developing nations need by 2030 to build more resilient infrastructure. The short bar is what's actually available. I mean, the gap is enormous. Without international help, these countries just can't afford to protect themselves. But here's the optimistic part. Investing in resilience isn't just a cost. It actually pays what the source material calls a triple dividend. First, you avoid massive future losses. Second, you actually spur economic growth through innovation. And third, you get all these other great social and environmental benefits. It's one of the smartest investments we could possibly make.
So it really all comes down to this. Climate change is, at its core, an economic problem now. The choice is not if we pay, but how we pay. Do we pay a smaller, predictable price now for a future we can manage? Or do we wait and pay an incalculable price later in a world of chaos? That question on the slide, that's not for some future generation to answer. It's for us, right now.